Hey everyone, welcome back to Corporate Decoder. Today, BTCT just filed an amended F-1 registration statement, and I'm seeing some serious red flags that matter. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing reveals a company trying to raise money while facing massive financial and operational challenges, and it hints at a potential AI pivot that might be too little too late. Alright, let's dive into what BTC Digital Limited is telling the Securities and Exchange Commission. They are filing an amended registration statement, basically an update to their plan to sell more shares. The first thing that jumps out is this filing is dated the 24th of August 2026, and it talks about selling up to 18.4 million ordinary shares. This is a big chunk of the company, and it is coming from selling shareholders, meaning the company itself isn't getting the cash from this sale. Now, BTC Digital Limited, ticker BTCT on Nasdaq, is primarily in the cryptocurrency mining business. But they're also involved in mining machine resale and rental, and they've recently announced an expansion into AI computing infrastructure. Notice this box is checked for delayed or continuous offerings. This means they can sell these shares over time, not all at once. This often suggests the company is looking for a steady stream of cash or is unsure how quickly they can sell everything. Now, let's look at the money. The financial tables tell a stark story. For the year ended the 31st of December 2025, their total revenue was about $14 million. That sounds okay, but look at the cost of revenues, which was a massive $17.2 million. This means they had a gross loss of $3.16 million in 2025. That is a negative 22.5% gross profit margin. In simpler terms, they spent way more to get their products or services ready than they made selling them. To put that in perspective, imagine a bakery spending $12 to make a cake, but only selling it for $10. That is a tough business to run. On top of that, their general and administrative expenses, which include things like salaries and office costs, more than doubled from $2.4 million in 2024 to $5.1 million in 2025. A big chunk of this increase was due to employee stock option plan expenses, which means they are giving out a lot of stock to employees, potentially diluting existing shareholders. The result of all this is a significant net loss. In 2025, their net loss was $9.1 million, a huge jump from a $2 million loss in 2024. They are losing money faster and faster. Looking at their cash situation, it is also concerning. As of the 31st of December 2025, they only had $350,000 in cash. That is a dramatic drop from $14.9 million at the end of 2024. This sharp decline in cash, combined with their losses, is why they flagged substantial doubt about its ability to continue as a going concern. This is a serious warning that the company might not be able to pay its bills for the next year. It's a bit like a household running out of money and not knowing how to pay for groceries next month. They do mention holding digital assets which were valued at $7.6 million at the end of 2025. They say they can liquidate these if needed, which is a potential lifeline, but the volatile nature of cryptocurrencies means this could be a risky source of funds. Now, they are talking about expanding into AI computing infrastructure. This sounds like a smart move in today's market, but the filing is very clear. This initiative is at an early stage. They have not entered into any binding customer agreements and have not generated any revenue from AI computing operations. It is like saying you'll build a factory, but you haven't even bought the land yet. Then there are the risks, and they are substantial. A big one is regulatory uncertainty in China. They state that any action by the Chinese government to exert more oversight could significantly limit their ability to offer securities or even make their shares worthless. This is a massive risk for any company with even indirect ties to China. They also touch on the Holding Foreign Companies Accountable Act, which puts foreign companies listed in the US under a microscope regarding their auditors. If US regulators can't inspect the auditors, these companies could be delisted. While their current auditor is in Singapore, which is good, this whole area adds a layer of uncertainty. Think of it like a conditional contract. It is okay now, but if the rules change, it could fall apart. And here is another big one, being incorporated in the Cayman Islands. They admit that shareholders might face difficulties protecting their rights through US courts, because Cayman Islands law is different and less developed in some areas compared to US law. This is a common issue for companies incorporated offshore and can leave investors with fewer legal protections. Looking at their strategy, they mentioned growing their current business lines and increasing research and development. They are also trying to offer crypto asset management services, and as we mentioned, expanding into AI computing infrastructure. It feels like they are throwing a lot at the wall to see what sticks, especially given their current financial struggles. When we look at their capitalization table as of the 31st of December 2025, we see about $350,000 in cash, but over $2.9 million in total indebtedness, including short-term loans and officer loans. This means they owe more than they have in cash, which reinforces the going concern warning. The list of selling shareholders is quite long, and it includes many investment funds. This indicates significant interest from institutional investors, but given the company's financial state, it is important to understand if this interest is driven by a belief in future growth or just an opportunity to exit positions. They also have to address us federal income tax consequences, specifically mentioning the risk of being a passive foreign investment company, or PFIC. If they are deemed a PFIC, it can lead to much higher taxes for us investors and burdensome reporting requirements. This is a complex tax trap that can significantly impact investor returns. The plan of distribution is pretty standard for these types of filings. The selling shareholders can sell their shares through brokers or in private transactions. They can also use things like hedging and short sales. The key takeaway here is that these sales could happen over time, potentially putting downward pressure on the stock price as more shares become available. They've included legal opinions from firms like Conyers, Dill and Pearman for Cayman Islands law and Dickinson Wright plc for US law. This is standard for these filings, but it highlights the complexity of operating a global business with different legal frameworks. The auditor, Audit Alliance LLP, issued a report that includes a material uncertainty related to going concern. This is the formal way of saying what we saw in the financials: the company's ability to continue operating is in serious doubt. This is a critical piece of information that investors absolutely must pay attention to. It is like getting a medical report that says there is a serious health concern. Looking at the balance sheet, their assets have decreased from about $41 million in 2024 to just under $40 million in 2025. Liabilities, however, have more than doubled from $1.2 million in 2024 to $2.7 million in 2025. This widening gap between assets and liabilities is not a good sign. The statement of operations shows consistent losses, with 2025 being particularly bad with a $9.1 million net loss. This is a trend that needs to be reversed quickly for the company to survive. In their statement of changes in shareholders' equity, you can see how much the accumulated deficit has grown. In 2025, it reached nearly $198 million. This means they have lost money consistently over time, far exceeding any profits they might have made. The cash flow statement confirms the dire cash situation. In 2025, they used $5.3 million in operating activities, meaning their core business is burning through cash. Investing activities also used a large amount, $15.5 million, likely for equipment and the new AI venture. Financing activities brought in some cash, but it wasn't enough to cover the outflows. The notes to the financial statements contain crucial details. For example, Note 2 reiterates the going concern issue and management's plans, including seeking additional financing. It is a hopeful plan, but the success of these plans is far from guaranteed. Note 7 details their digital assets, showing a significant increase in holdings to $7.6 million in 2025. This is important because it is their primary source of liquidity beyond the recent financing. However, it also highlights their heavy reliance on the crypto market, which is notoriously volatile. Finally, the exhibit index shows a lot of agreements, including the Securities Purchase Agreement and Registration Rights Agreement, related to this offering. It also lists many prior agreements, suggesting a history of transactions and financing rounds. In conclusion, BTCT is in a precarious financial position. Their crypto mining business is not profitable, and their new AI venture is still just an idea. The significant increase in losses, the drop in cash, and the going concern warning are major red flags. While they are trying to diversify and raise money, the path forward looks very challenging. The risk I am watching is whether the AI pivot can generate revenue quickly enough to offset the ongoing losses in their core business, and if they can secure sufficient financing without further diluting shareholders to a point of meaninglessness. What is your take on BTCT's chances? Let me know in the comments. If you found this breakdown helpful, please hit that like button and subscribe for more. The tools I use to decode these filings are linked in the description below. That is my take. Stay decoded.